Hello everyone, hope you all are doing great and having a nice Wednesday. All right, so today we're going to be taking a look into UXD. Okay, is it the perfect stablecoin? And as usual, we have a few slides, and we are going to be discussing three items in the agenda for today, which is okay. So the first would be stablecoin trilemma. Okay, the stablecoin trilemma, we'll touch on that, and we'll just understand what is that, and we will we'll take a look into the different types of stablecoins, and we'll also be taking a look into the UXD protocol itself in the end, and probably we're going to do a demo in the end. All right, so let's jump right in, okay, and see how it goes. All right, so the stablecoin trilemma, okay, what is it? Okay, the stablecoin trilemma, there are three components which makes a stablecoin close to a perfect stablecoin asset. Okay, so basically these three components are, the first thing is it needs to be capital efficient. Okay, that means the ratio, the mint and burn ratio, it needs to be 1 to 1. Okay, for example, like if you burn $200 worth of an asset or a collateral, if you mint like $100 worth of like the stable coin, the ratio is 2:1. All right, so it's not capital efficient because you're depositing more collateral in order to mint less of the asset that you want, or the stable coin that you want. Okay, so it's 2:1. We need to make this like 1:1. So when it is like the ratio is like 1:1, that means you deposit $100 worth of collateral, and you mint $100 worth of like the stable coin. That means it's capital efficient. Okay, and also liquidity, more liquidity for people to go in and out of the market, and so on and so forth. It needs to be able to handle the market itself. And the second thing would be decentralized. Of course, like nobody should be able to freeze it or like, censor it, and so on and so forth. And of course, stablecoin job, the most important thing is to be stable. Okay, it needs to maintain the peg to whatever asset it's being pegged to, and so on and so forth. And we'll elaborate all of these in each types of stablecoin. But let's keep this in mind. Stablecoin trilemma. Okay, capital efficient. It needs to be capital efficient. It needs to be decentralized. It needs to be stable. We need to assess for all of those three in order to make sure whether a stablecoin is close to perfection. All right, so let's take a look into the total stablecoin supply market. What happened in the past 2 years? In the past 2 years, this is just to assess like what the potential of the market could be, and if we take a step back and understand like, hey, what is a stablecoin basically? Okay, a stablecoin basically it's something people use, or whatever, like algos use in order to hedge the volatility in the market. That means people can create different markets out of different volatile assets, like for example BTC, ETH, Solana, whatever. And you need to have a stable coin in order to hedge that volatility, so that people, traders can go in and out, and depending on the market outlook, swing traders can also you know come in and out of the market. And it's a useful thing to have. And I would say, like, and due to the surge in DeFi, I would say like it's one of the fundamental asset which is needed in order to access DeFi and to explore that whole ecosystem of DeFi. And of course, like, there'll be in the future there are going to be like real world use cases, and so on and so forth. Like you can do like e-commerce, POS, like, and remittance cross border. People are doing this, but like, I mean, in low volume right now. Okay, but anyways, so that is why, like, the market cap as of right now of the stablecoin, as you can see, it's exponentially, it's growing since the last 2 years, and it's approximately around like 150 to 200 billion dollars is the approximate market cap of the total stablecoin market, that all the types of stablecoins that we have right now. But what is the potential of this market? What is the potential? The potential of the stablecoin markets is to go after the narrow and broad money. What do I mean by narrow and broad money? Narrow and broad money is basically like, the Fed calls it like M1, M2, M3, and those sorts. And I would say like, this is basically like the banknotes, or like, the coins, and like, the funds that we have in our checking account or a savings account or the bank's account, whatever we have. So that's like the narrow and the broad money. All right. So, and the entire market of that market is approximately like 90 trillion as of right now. So So if you want to understand like, hey, what is the potential of like the stablecoin asset itself, it's that market. Okay, so because that is the one of the most prominent use cases, or like the market to go after. And of course, like it's depending on like, the advancement in technology, the market is of course going to grow. All right, so at least that is the market, and that is the market potential for the stablecoin itself right now. But anyways, there are four different types of stablecoins. I'm sure like most of y'all know these four, but anyways, just to refresh all that, refresh what we have learned in the past. There are four different types of stablecoin. Okay, fiat backed, you have crypto backed stablecoin, which is nothing but like CDP, or collateral debt positions, and you have commodity backed stablecoins, and you have like algorithmic stablecoin, which are like which are growing in demand as of right now. Okay, so there are pros and cons to everything, and we'll just touch on all the details. But if you want to take a look into all the different types of stablecoins that we have listed on the market, I mean in CoinGecko, you can just go to that and go to this link, and you'll see this. There's approximately like 70 different types of like stable coins. Okay, so and yeah, people are experimenting and so on and so forth, and making progress. That's amazing. That's really great. But let's take a look into the fiat-backed stablecoin. Okay, so the fiat-backed stablecoin, of course, it's issued by a central authority. Okay, so the first thing itself, it's not decentralized. Someone can censor it. Why? Because it's issued by a bank, in the sense like, for example, by a company, for example. Circle, okay, who is the one behind USDC, the stablecoin. They have a traditional bank account, like just a normal TradFi bank account. They deposit, let's say, for example, $1 worth of, like $1, $1. Okay, they deposit in that bank account, and that bank allows them to mint $1 worth of USDC on the blockchain. Okay, so they are balancing it out. Okay, so that means it's capital efficient. Why? Because the ratio is always $1 in, $1 out in the blockchain. Okay, so that's great. Okay, is it stable? Yes, it is stable. Most of the times, yes, it is stable. Okay, but is it decentralized? No, it's not decentralized. Someone can censor it? Yes, someone can do that. Why? Because it's done in a bank. Okay, so that is the thing. Okay, so authorities can do that. Okay, and as you can see over here from we have seen Circle freezing 100K worth in USDC from request from law enforcement. Okay, so this could happen. And also Tether can do that. Tether, Bitfinex behind Tether, they could also do that. Like as you can see over here, 160 million of USDT stablecoin uh, was frozen on the Ethereum blockchain. So I mean, there are a lot of instances like this, if you dig in. But anyways, there's no commentary on all of this. It is what it is. That's the feature of a fiat-backed stablecoin, and the just the facts. Okay, no comments other than that. Anyways, crypto-backed stablecoins. Okay, crypto-backed stablecoins are commonly known as CDP. Okay, CDP is collateral debt positions, and the first dApp, like the OG dApp, which comes to my mind is MakerDAO. Okay, one of the first dApps on Ethereum or DeFi, I would say. So yeah, so crypto-backed stablecoins, they are issued by protocols like MakerDAO or by DeFi protocols. What they basically do, the function is basically it accepts a collateral, and it spits out a debt in the form of a stablecoin. Okay, so for example, like, and some of the examples are like DAI, you have MAME, like Magic Internet Money, you have Cash, the Cash IO app on Solana, and so on and so forth. And it's the problem with this is like, or the deficiency is like it's not capital efficient enough, and we will understand why. So, but just try to understand like, hey, it accepts collateral and it issues debt as a stablecoin. Okay, so now let's take a look into the Oasis app, which is nothing but the MakerDAO itself. And there are different vaults. If you go to oasis.app, you will take a look, and you can see all these different types of vaults based on different assets. So yeah, so as you can see over here, like I mean, this like the Ethereum, the minimum collateral ratio is 170%, Wrap BTC 175, Link 165%. So what does this mean? What does this collateral ratio mean? It means basically, I'm sure like some of you already know this, or maybe most of you already know this, but anyways, just to revise on that, it would be like in order to mint, you know, you can deposit ETH in this vault and you can mint DAI. But how much? How much? The minimum collateral ratio is 170%. What does this mean? This means you can mint $100 worth of DAI, but you need to deposit $170 worth of Ethereum. Okay, so that means you're adding more and you're getting less. Okay, so that is why it's not capital efficient. Okay, so that is exactly why it's not capital efficient. And of course, there are risks in this. If the minimum collateral ratio is 170%, if it's that high, it's people get liquidated. If the price of the Ethereum asset or like any of these assets over here, it drops, people have the risk of getting liquidated, and we have seen this in the past. We have seen this in Black Thursday. There are liquidators who went in and who just like auction, $0, zero DAI, like they paid zero DAI in order to liquidate 8.3 million. Okay, so for zero DAI, and of course this was due to a bug, but anyways, the risk is the liquidation. So if you have such a high collateral ratio, you risk being liquidated, and once you start being liquidated at that high collateral ratio, there could be different bugs in the protocols of the on the DeFi protocols, and it could lead to these sort of like scenarios. That's all I'm saying, and these are facts. You can check it. Anyways, so the Cash IO app, which is on Solana, it does a very interesting thing. What it does is like a Saber, like there's a LP, there's a liquidity pool on Saber, which comprises of like USDT, like Tether, and USDC. Okay, so basically, once you create a LP position over there, you come to Cash IO app, and then you can deposit that LP, and you can print cash, which is also a stable coin. Okay, so this is exactly what you're doing. So at least in this case, like you're doing it with a stable LP and you're minting an LP. But even though you see over here there's a bit of like discrepancy in the value, like one cash is equal to 0.9652. Okay, so that means yeah, there's always this exchange rate thing, it just fluctuates here and there. But like anyways, so these are some of the few examples of like the crypto-backed stablecoin. So it's not capital efficient enough because of the high collateral ratio, and it causes a risk of like liquidation and so on and so forth. And of course, like this could happen too over here as well, because in this case, like USDT and USDC, it's like centralized stablecoins. Okay, so you're using centralized stablecoins in order to mint like cash, which is I mean, that means if you freeze USDT or USDC, I mean basically this becomes there's no way, like probably of course, like you can exchange cash to like Solana or any other asset. But anyways, and the LP in Saver, that will be under threat if they decide to freeze for whatever for whatever the reason. I hope that's not the case any day, but that could be. It's a possibility. It's a possibility, because if you back it by centralized or fiat backed stablecoins. So yeah, the third one is commodity-backed stablecoins. Commodity-backed stablecoins is a stablecoin which is like commonly pegged to the metals, like or ETFs, yeah, or anything you could peg it to. Like any sort of commodity, you can peg it to, and you can create a stablecoin out of it. For example, like over here, as we see, like Tether. Tether Gold and Pax Gold, So, yeah, so these are some of the commodity-backed stablecoins that we have. That means you're just bringing the gold, the gold's market into like, the crypto world, into the crypto land, okay, into the blockchain. So basically, you're doing that. But anyways, these have very limited use cases and it's not very transparent. And limited use cases in the sense like, do you want to use like XAUT? Have you have you ever tried it to using on any DeFi protocols and so on and so forth? Most probably not. Okay, but is there a market for this? Probably, yeah, there is a market for this, and that's why they've created probably people who actually have gold or something like in real life. They probably want to use some of this new technology, and in the end, like everything, like anything that can be digitized will be on the ledger, on the blockchain. Okay, so that is very important to understand, and we are seeing like a few of the use cases right now, and bringing in all these types of commodities and creating stable coins out of it, and we will continue to see these sort of things. But anyways, as of right now, there are limited use cases of this, and also there's a issue with like transparency, as I mentioned. Like if you Google this, you will see like discrepancy identified in the transparency data provided by Pax Gold and Tether Gold. So that means there's not enough gold, like real gold, which is backing that stable coin. Okay, so that is where like they're minting probably it out of thin air or something like that. So that's why there's a transparency issue, and man, it's a risk. It's a risk. So you need to be careful while you use this in order to make sure like everything is audited clearly, and you have enough conviction or transparency in order to actually assess it yourself and do your own research, just to before doing all of this. But of course, like you can still use it, but like if you just get caught up in one of the situation where something is frozen, or like there's a risk, and like there's not enough a real asset which is backing that stablecoin, it could be a problem. It could be a serious problem. People don't we don't think it until it happens, but when it happens, it's like when the shit hits the fan, it's a problem. Okay, so we don't want to be in that situation. But now, algorithmic stablecoin, which is the next iteration of the stablecoin itself. It has much more wider use cases, much more demand in the market. It has a good product market fit, I would say, and also it depends on different dynamics of like different mechanics or the system mechanics that they use, like supply and demand, mint and burn, and all that kind of like good stuff, like the mechanics that they use in order to create these algorithmic type of like stablecoins. And these are like, in the early days, you had like Ampleford, you had empty set dollar. Now you have UST, which is from the Terra side of things, which is which is pegged to like, the value of one UST is $1. And these are not backed by dollars or like crypto. It's mainly done through different types of like algorithms and different types of mechanism within the protocol itself. All right, so but let's take a look into the empty set dollar example, like the stablecoin, the algo stablecoin, and Amplify. Okay, so basically, as you can see over here, the chart over here, does it look like stable to you? As you can see, the value always goes up, and now it's just gone flat, down. It's basically gone to zero, ESD. Okay, so empty set down, and as you can see, Amplify is like, it's volatile. It's not a stable coin. So it basically, if we come back to the trilemma of stablecoin, like, hey, ESD amplified. Is it decentralized? Yes, it is decentralized. Is it capital efficient? Probably. Is it what is it, stable? I don't think so it's stable. The chart over here, it doesn't tell it's stable, it's not stable. It has volatility, and look at this ESD, it just goes down like a like a meme stock or something like that. But anyways, no comments on that. But anyways, like I mentioned, algorithmic stablecoin, like coins like UST, Terra stablecoin has done pretty insane in the Q4 of 2021, as you can, and that's why, like, if we take a look at the quarterly Q4 market cap and the growth of different types of stablecoins, as you can see, the entire market cap in quarter four alone in 2021, it grew by like 29%, all the different types of stablecoin. But if we classify into different types of like the stablecoins that we have, like fiat stablecoin, it grew by like 18%, the market cap. Okay, CDP, which is the collateral debt position, like I showed you, MakerDAO and so on and so forth. Meme, Magic Internet Money, it grew by like approximately like 87%. And algorithmic stablecoin, it went ballistic, parabolic, as you can see over here. Look at this. There's no comparison. 260% growth in market cap in Q4 2021. So what does this mean? That means it has a product and market fit. People want algorithmic stablecoin. This is what this chart tells me. And it makes sense. But anyways, let's look into, how people take advantage of the different arbitrage opportunity in the Luna UST ecosystem, okay? Because Luna and UST, it goes hand in hand, okay? Mint and burn. Okay, so that's what they do. And why do they mint and burn? Because of the fluctuation of the peg. If UST goes above the peg, they basically, what they do is they mint $1 worth of UST from Terra by burning Luna. Okay, so they when it goes above the peg, they mint $1 worth of UST from Terra by burning Luna, and what they do is they sell it in the open market. They sell UST on the open market above the peg. Okay, why? Because they want to sell high, and then if the USD goes below $1 or below the peg, if UST is below the peg, do not mint, buy on market. That means they're buying low, they're buying UST low, below $1. They mint $1 worth of Luna by burning UST. Okay, that's what it happens in the protocol. Okay, so basically what this happens is like when the peg of UST is high, they sell Luna in the open market, and when the value of like UST is below $1, they actually buy, and then they again sell that into the market. So they're buying low and selling high, and that's how they make that arbitrage. Okay, so there is always this arbitrage in Luna and UST. That is one thing to remember. All right. So, but what this could cause is like this is good when the market is actually going up, or like it's climbing or it's growing. That's really great. But if the market turns around and like if it starts to go down in the other direction that we don't want, it could cause a systemic risk to the entire protocol. And that is why I feel like if you read more about the relationship of Luna and UST, you will understand that it's probably not sustainable, in my opinion, in the long run, because you have this and it doesn't actually, it's not like it doesn't fit, the stablecoin thing. It's good when the market is going up, when there's enough reserve and so on and so forth, but the thing is, you would need to inflate the Luna into infinity in order to maintain that peg, or in order to continue this whole system what they have over here. And that is exactly why it's like it creates that existential risk. Okay, and there's no comment to the protocol itself. Of course, you can go and do your own research, but according to my research, this is it's not like suitable for a stablecoin in the long run. Okay, but we'll see. We will see. And now it comes like UXD protocol. Okay, the UXD protocol, it brings a different paradigm to the how how we can think about stablecoin. Of course, the stablecoin trilemma remains the same. It needs to be capital efficient, decentralized, and stable. And UXD over here, it's a USD pegged algorithmic stablecoin, which is called UXD. That is the token name, and it's a USD pegged in the sense one UXD is always equal to $1, but it's not backed by a dollar. Okay, that's the main thing. It's backed by 100% delta neutral position, which I'm going to show you shortly what is the delta neutral position. But anyways, delta neutral position is basically a risk-free position. Of course, there are risks, but it just by the math, it's a delta neutral position. They're hedging always and they're creating that position. Okay, and how do they do that? They leverage the derivatives market. Okay, specifically the dated futures and the perpetual swaps. They use those market and they use the long market. Okay, spot market. So basically over here, this is how they create the delta neutral position. Okay, so they long the asset in the spot market and then they short that asset in the futures market. So meaning, let's say if you like let's say the collateral is BTC, okay? So they long $1 worth of BTC, and for that $1 worth of BTC, they are going to open a short position in the futures market itself. So that is how they are creating a balance, okay? Action, this is a reaction. Okay, the action that they're taking is they're going long, but what is the reaction to that? They're always doing this, and this happens like automatically in the back end, in the protocol, in the UXD protocol itself. So basically, what this means is they they are mostly depending on the price action of the asset itself. Okay, the price action of the asset. So that means it's much more sustainable, in my opinion. Okay, whether it goes down or up, there's always a chance to go long and always a chance to go short. The market could be whatever. It could go down or up. So there's always like you can create this delta neutral position. That's what I'm saying. So, anyways, let's take a look into the stakeholders, of the UXD protocol. Who are the participants within the protocol itself? So, of course, you have the stablecoin holders, the UXD stablecoin holders. You have the governance token, which is called UXP, and these are participants who, create or direct how they want this protocol to progress, or decide on certain things, basically the community. And there's also the insurance fund. Insurance fund is like, they raised a bunch of money during the IDO of the UXP governance token, and they raised approximately like 57 million. So that is the insurance fund, and this insurance fund will act, will come in handy at times when the market is going down. That means, like UXD stablecoin holders would not need to pay for that. They would not need to pay. It would be funded by the insurance fund. So this is more like a backup fund, which is created. Okay, and these are the three main stakeholders within the UXD protocol itself: governance token, the stablecoin itself, and the insurance fund. Okay, but how does UXD work? The stablecoin, how does it work? And we will look into the demo, after we finish the presentation. But just to understand, you need to, as of right now, you can deposit like three different types of like asset or collateral. You can deposit like BTC, Sol, or ETH, and you can mint UXD, the stablecoin itself. So that means the same story. Okay, 100% delta neutral position, and for example, you long BTC spot and you short BTC USD, like the futures market, and the ratio of that is always equal to 1. And that is exactly why the value of UXD will always remain 1, because of you're creating that hedge in the market. So action and reaction, like I showed you in that image. Okay, so and also, let's say the USD, if the UXD the stable coin deviates from the peg. Like if it say like if it goes above and low from the peg, always there could be arbitrage. People can come and make like profit. Arbitragers could come and make profits, or algorithms, you know can come and make profit out of that. Even you can do that if you see that, and if you're quick enough to do that with. But of course, like, basically, the capital needs to be large size, I would say, in order to actually make significant profit from that arbitrage. But anyways, let's take a look and see what happens when the UXD price is under $1. Okay, what happens then? Basically, the arbitrageurs, what they can do is basically they can return the UXD. They can return the UXD to the protocol to unlock $1 worth of collateral, because you have to remember, all BTC, Sol, and ETH, it is decentralized crypto assets, and that is what, like, you can mint UXD from them. And that's why, like, if you return, or if you redeem your UXD, if you deposit your UXD to the protocol, it'll be much more clear when I show you. But in order to, like, just to understand, you need to return the UXD in order to mint $1 worth of the collateral. Like, let's say that's why it's always like, the ratio is always one, right? So if the value of, like, the peg is under $1, you need to redeem UXD for $1 worth of, like, BTC, ETH, or Sol. Okay, and basically how it does is, it reduces the UXD supply, because once you return the UXD, you're reducing the supply. Once you reduce the supply, the value of the UXD stablecoin itself, it goes up. Why? Because you're reducing the supply. When there's less supply, the demand remains the same. The peg comes back to, like, $1. And the opposite happens when the peg is, like, over $1. Okay, you increase the supply, you dilute the supply of UXD. That means what arbitrageurs can do is they can deposit collateral in order to create more UXD. And once you create more UXD, you create more supply of UXD stablecoin. And that is why, once you have more supply, the demand remains the same. Once you do that, it dilutes the value, or it dilutes the value of 1 unit of UXD, and it brings the value, or the peg, back to $1. Okay, so that is how it works, and it works opposite. So if it's under $1, it actually reduces the supply. You reduce the supply by returning UXD to the protocol and minting a collateral. Once you reduce the supply, the demand remains the same, and the price comes back up. And if it is over $1, you dilute the supply by increasing the supply of UXD, by depositing collateral and minting more UXD from the protocol itself. But anyways, all this, like, UXD, of course, like, it's decent. Coming back to the stablecoin trilemma, okay, decentralized, capital efficient, and stable. Okay, it is decentralized because it is, you can mint UXD only by using crypto assets, like, which are decentralized itself, like BTC, ETH, Solana, and maybe other assets in the future. And okay, and it is capital efficient. Yes, it is capital efficient because you always hedge your long and your futures position, right? Like, that is why the ratio is always one, and you're not adding more BTC, or you're not adding more Sol or more ETH in order to mint one unit of UXD. So if you deposit $1 worth of BTC, you can mint $1 worth of UXD. So that is why it is capital efficient, and it is stable. Okay, as of right now, I've been watching that market for a while. It's it's pretty good, like, I would say this is much more scalable, much more sustainable, and I mean, it would eliminate some of the risk, like, your funds being frozen, or, like, people coming, and, like, it doesn't cause that existential risk. Why? Because it's much more, it depends on the price action of the asset itself. But however, there are risks, there are different forms of risk, and there are so many unknown risks within the protocol. It could happen, okay? But here are some of the known risk, what could happen, okay? So as of right now, smart contract risk. It's a protocol, it's a smart contract, it's a Solana program, there could be bugs and so on and so forth, and it could lead to a lot of different consequences that we don't want or that we don't like. Okay, so smart contract risk and negative funding rates, because it's related to the derivative market, we need to understand like, hey, when the negative funding rates are like, when the funding rates are negative, that means the sentiment of the market is short. And once the sentiment of the market is short for too long time, that means if you remember, like, we had one of the stakeholders in the UXD protocol is the insurance fund itself. Okay, so if the insurance fund, that 57 million, if it burns out, then I mean, because they are going to pay for, like, they're going to pay for that negative funding rate, so the market shouldn't be like going down for a very long period of time. That means it needs to come back and have a positive funding rate just to make it balanced, so, and yeah, so negative funding rate is not good for extrapolate amount of time. So make sure yeah, the market needs to make sure that doesn't happen, and that could cause a risk to the protocol itself and to the stablecoin itself. An insurance fund, asset management, that means the insurance fund that I mentioned that they have for backup, you can use this fund in different yield strategies. Like, you could use it in DeFi option vaults, you could use it in like different DeFi opportunities in order to generate or manage your asset, or maybe generate more and add more to the insurance fund itself. So and all these insurance fund is used when the funding rate is negative. So that is exactly why, like, you want to always increase the value of the insurance fund. So if you use that capital in different yield strategies, you're adding more risk, because if depositing that fund elsewhere, it's also smart contract, right? Those other DeFi protocols that you have, and if it fails, then you have that cascading sort of a risk, and it all relate back to the protocol, the UXD protocol itself and the stablecoin itself. So there could be risk on that, and of course, like, insufficient liquidity to exit UXD positions. That means if there's not enough liquidity in order to, like, let's say you want to redeem your UXD for as of right now BTC, ETH, and Sol, and there's not enough liquidity in the futures market for those sorts of assets, then I mean it could cause some imbalance. And of course, you have the supply and demand imbalance, which can cause due to various market conditions, as you're aware. And since it's like pretty early, I would say, like, do more research on this. But anyways, however, these are some of the risks that you can that are there right now for you to know. And of course, there are unknown risks which could have come out of nowhere, And this is the insurance fund that I was mentioning, that they acquired during their IDO of the UXP, their governance token. So people who participated in this IDO, yeah, they were like 3,676 number of investors, or yeah, the people who invested and got UXP token, and they raised approximately like 57 million, as you can see over here. All right, so just to recap the entire thing, I know it was a lot, but anyways, to take everything from the top and just to make sure you get a clear understanding of where we are right now in the stablecoin market. So what we see, fiat-backed stablecoin, centralized, okay? That's the problem. Crypto-backed stablecoin, it's not capital efficient. Why? Over collateralized ratios, okay? And commodity-backed stablecoin, it lacks transparency. Algorithmic stablecoin, UST is better than like EST and Ampleforth and so on and so forth, but it's not sustainable in the long run. Okay, and so that is why, like, and then comes, like, UXD, which is another algo stablecoin, but it's done not like it's not due to a different asset, but it's mainly due to the spot market and the futures market. So there is always going to be spot market and futures market, and that is where the liquidity is. I mean, huge amounts of liquidity is mainly in the derivatives market. Okay, so mainly these guys are doing it using the derivatives market, and also, of course, that is a risk, but, like, I mean, nevertheless, it's a progress to that stablecoin area that we see. And of course, like, as we have known, like, algorithmic stablecoins, they have a product market fit because people don't want to be censored or frozen out of their bank accounts or whatever, or, like, in the blockchain your funds are frozen and you cannot do anything with your ledger or whatever you have. So that's not ideal. So that's why algorithmic stablecoins will continue to grow. We will see a lot of different progress. But anyways, in my opinion, I would say, like, UXD is right in the forefront of this, and I would say, like, it's far, far better than any of the stablecoins that we have seen in the market. At least that's my opinion. But you do your own research, and of course, as you have seen, there are a lot of different types of risk, and you know, things could go wrong, but things could go right as well. If there's a lot of demand of UXD and people don't want to be censored, people just start minting UXD and start using UXD. UXD becomes the stablecoin in DeFi, and not just in Solana, but any other protocol. That'd be huge. So there's always both sides to it. And of course, the UXD, it solves the trilemma of the stablecoin itself. It's decentralized, it's stable, and it's capital efficient all at the same time. So at least that's what they say right now. We will see how it plays out, but I think it will hold pretty well, in my opinion. I just get that feeling, okay? And yeah, I think it'll hold pretty well. And if you want to learn more about them, just go to their docs, and yeah, let's quickly go take a look into the UXD protocol itself. If you go to uxd.fi, you can see just launch the app. As you can see over here, you can read all that stuff that I explained today, and you can see all of that. It's backed by different investors. As you can see, Alameda, of course, Alameda, Multicoin, Defiance, CMS Holding, Solana Foundation, Mercury, and Tholi Raj. They are the founder and the co-founder of, like, Solana. So yeah, Dylan from Saber, and you have all these guys who are backing this protocol. So that means, I would say, like, I have more trust in them, because I just, like, I mean, it should be trustless, but anyways, like, these are prominent people. They're not here to rug you or something like that, but who knows. I'm pretty confident. Okay, when I see those investors, like, backing a protocol, I'm pretty confident that uh, it's much more better than what we have right now. All right. So, but anyways. If you take a look into this, like, if you just launch the app and get to, like, of course, you can just acknowledge, read the terms and services, blah blah blah, connect, and you can connect with any of your wallet. And as you can see over here, you have two options, very simple. Okay, mint and burn. Okay, so you mint with either one of these three assets, and you can, let's say, for example, like, $1. Okay, so, like, one Solana. Okay, you will mint, like, currently the price of, like, so how much is it? Let's go to, I think it's like $93 right now. Let's see. But anyways, um, yeah. So basically, it will mint the exact uh, the value would be like 1 to 1. Okay, so if this is like one Solana you're minting, and whatever is the value of Solana in terms of, like, US dollar, that is the amount which is going to be minted. Right. So let's see. Hmm. What is Solana's price today? Come on, faster, faster. Come on. All right. So as you can see, like yeah, so Solana's price is approximately like $93. So as you can see, it's the same. Okay. So that is what it is. And if you do the same thing with Bitcoin, let's say one, it's like 3900. Yeah, it's similar. Okay. So 39. So that's the thing. And if you want to redeem it back, like you just deposit like UXDC, like whatever, let's say $100, whatever, $100 of like not dollars, like let's just say like 100 UXD, which is, it's a USD peg, so which is, but it's not backed by USD, so it just means it just gives you back the collateral worth in BTC. If you want an ETH or Solana, you get the idea. Like if you want that, it'll give you an ETH. If you want a Solana, it'll give you in Solana terms. All right, so that's all for now. And I mean, yeah, and you can trade it on Jupiter and all that stuff. You have different markets already in the AMMs and DEX, and I guess Jupiter is probably a good aggregator, so you can use that. It's amazing. And yeah, the supply, the supply cap, they keep on increasing the supply cap UXD, because that means more people are willing to actually mint the UXD token itself. So there's a demand for this, and keep an eye on this. And if you want to learn more, of course, like just you don't have to take anybody's word, on there. You just go and do your own research. Go scroll down and just go to their docs and get involved within their community. You have all their Twitter and GitHub, and you can check it for yourself. You can read about like all the basic, what are the different functions in much more detailed and all that stuff. But for me, like yeah, I just summarized everything and took everything from the top, like the entire stablecoin story and where we are right now from where we came from. So I hope it was helpful, and I hope it just refreshed all those learnings what you have learned in the past. And if this was new to you, I'm sure like you're gonna learn even much more by going through the docs. So we're in the forefront of like bleeding edge technology as always, and I think UXD it solves the stablecoin trilemma, and I think it's here to stay, and it will continue to evolve, and maybe we're going to see different iterations of these sort of like techniques to in order to mint stablecoins and so on and so forth, because ultimately the end game is like to have all the three components of the stablecoin trilemma in order to be solved in one asset. So that's the end goal. All right. So take care, guys. Have a nice day. Have a nice week. And I'll see you when I see you. All right. Bye now.